Hello, everyone. Welcome to today's session. Let's go ahead and get underway here. Market conditions pulling back just a little bit here. Still bullish in a bull market. We're at the upper end of this range. We've been talking about this range now for quite some time, talking about a little bit about the economic backdrop with interest rates and inflation and some geopolitical risk happening in the world today that's spooking the market a little bit here as well. We're sitting at bull market conditions at 26. That is this momentum trend right here. And we'll talk a little bit about this area. Now, this is an area that we've been talking about most of the year because we're at the upper end of the range. So really any news at all that comes up oftentimes will move the market, but it can be, it may be just a catalyst or just an excuse or just a reason for some selling to take place, even based on where we're at in the current trend. Now, we're seeing a bit of a move blower today, but again, this upper end of this range is due for a correction. It's due for a pullback. Even though we are in bullish market conditions, we are at the extreme end of this bull market. So what that means is, in terms of overall exposure to the market, that's the biggest category. That's the biggest factor in this portfolio methodology and stock trading methodology is exposure to the market. How big of a position do I have? Where are my stop losses? How many holdings do I have based on my total portfolio size, based on my cash levels? Okay, so those also have to do a lot with your risk tolerance and the suitability for equity exposure in the stock market as a whole. And remember that any stock can drop. Okay, there's no such thing as a good stock. There's no such thing as a safe stock. They all have volatility. Now, that doesn't mean that they're going to go out of business. Even Walmart and stocks like Kroger and General Electric and Boeing and Microsoft and Google, those stocks, and Apple, those stocks are amazing companies that are going to be around for a long time, but their stock prices are on, they're in an auction and run by emotion, and we get the upside of that, and we get the downside of that when we're dealing with the overall price finding process of the stock market. Okay, current short-term market conditions here, S&P 500. This chart right here is the SPY. We're seeing the upper end of that range, so we'll look at a little bit closer on some detail here, but we could certainly get a little bit of a retest right here. One of the things to start to be aware of on this indicator, and we've talked about this a few different times, is when we start to see the sentiment side of that starting to drop and the momentum and breadth starting to close higher than that sentiment. Okay, that can often mean that we're getting some selling. Now, this sentiment is based on the VIX, which is the extrinsic value of S&P 500 put options. So it just means that larger institutions are buying more S&P 500 put options when we start to see this go down in value. Okay, so and we're certainly at an area where an institution may say, hey, I want to buy some put options. Put options go up when a stock or a market goes down, and they're utilized for hedging. Oftentimes, it's one of the ways to be able to use those. So that's not the exact only reason, but it is an area where we're going to start to see maybe some profit taking, maybe some adjustments in portfolios as well. And so this could start to matter. Obviously, we're focused on price more than anything else, but we're seeing momentum, not extreme, but in that bullish trending zone, and a day or two of a pullback may actually be healthy. We're also not extreme up in that momentum range. We are in the upper end of that range. We're just not to that extreme area. We'll look at another chart here as well. And then breadth has been doing quite well. Breadth and sentiment. That you can see that sentiment. We've talked about some of the divergence starting to happen here as well. Now, breadth can also be looked at with the buy-sell ratio, and we're starting to see those not as extreme or wide as they had been, and in fact potentially coming back together again. We're seeing this spike in buy-sell ratio back here, which was at 4.21, and now we're sitting at 2. So we're still 2-to-1 buys to sells in the overall database, which means looks something like this: 1,900, 2,000 stocks up for every 1,000 stocks down. That gives us this 2-to-1 ratio. This doesn't include holds in there as well. So you're going to get a few that are in there that are not either in that uptrend or downtrend. They're just stuck right in the middle. Now, this other indicator here, looking at sentiment, this is S&P 500, and the upper end of this range here, you can see that it can reverse at the levels that we're at currently. Okay, so these are the times to start to make some of the adjustments in the portfolio that you may want to make if you want to reduce some of the exposure, getting stopped out of trades, selling some of the losers in your holdings, tightening up stop losses on some of the winners as well at these ranges. This volatility, let's look at this one here as well. That's also kind of stuck right in the middle. Nothing super interesting at that on that chart, at least on volatility. And then also the bond yield curve, which I'll bring up here again each of these sessions, because we talk about what's happening in the bond market, and we know that the short end of this yield curve has got to be taken care of. If we look really though in the last few weeks, really this short end of this yield curve on this 3-month time frame, we are seeing it. If I kind of scroll this up a little bit, watch that end of that yield curve, you're seeing it coming down. Okay, so we know that the Fed has made some adjustments with interest rates, and that's starting to show up. So we're starting to see interest rates on the short end of this yield curve start to come down a little bit, and that doesn't necessarily mean that that all is well, because oftentimes the high interest rates for this length of time have not truly been felt yet in the economy, and that's the potential concern going forward. Now, if we start to see some other issues that may affect corporate earnings or anything else, as far as you're seeing a large number of company layoffs. They're not hiring as much. Different things like that are going to be looked at closely as far as economic data going into this next couple of months. We're also now October 1st. Traditionally, October is a bearish month going into November, December. So we'll see if we get some more of that here in October. Here's our look at SPY, which is the ETF for S&P 500, and you're seeing this pretty decent bearish bar happening, at least as of right now. That also is ticking that short-term signal down to bearish, as you're starting to see some of these shorter-term support levels getting taken out. That real next area to be watching now is that 562 range on S&P 500. Let's jump over and look at Dow. Let's look at NASDAQ first. NASDAQ had been holding up in this momentum zone, and it's starting to weaken here a little bit as well, starting to pull back into that 475 range, back into that corrective zone, that corrective range in that 382 to 618. We can still be in an uptrend, okay, this overall uptrend, but it's just correcting that, retracing that, and then finding more upside. At least that can happen until it does, until it works its way all the way back down again. But these are starting to crack a little on some of those trends. S&P 500, or that's the NASDAQ 100, the triple Qs. The Dow Jones Industrial Average also showing some weakness. It had been the strongest moving up into this rally, the breakout here, and now we're that 418 level, which is about Dow 41,800 roughly, on a pullback for Dow Jones Industrial Average. Bonds, we're seeing TLT had a pullback into that momentum zone 236 and starting to work back up a little bit, or at least holding some support there. We'll see if it continues to move. And then SHY getting a little bit of a pullback here. And remember that inside of this upper range, we can get some volatility, some range-bound price activity, ultimately still in an overall uptrend, but just having this amount of volatility on. And this is SHY, the short-term bond market. If we jump over to sectors and see what's happening here in sectors, we're seeing still, at least as of today, this may change when everything updates, but we're getting more buys than sells. That's still the overall bias. We're still seeing that in the buy-sell ratio. We're still seeing it in sectors, but that can turn quickly. Keep an eye on that. That bias is starting to at least soften a little bit from real solidly bullish into a little bit more weakness. S&P 500 didn't, it's not turning back to hold. It's getting closer. Momentum's at 84 right now. When we get to about 70, that's about that cutoff line when we start to get the back into the non-trending zone or the yellow. Remember that most of the time we're looking for either a green or a red, okay? And the market right now, this yellow range is the non-trending, and you can see how often in the last, this is a 2-year chart. You can see once that is consolidated, oftentimes in a good solid uptrend, it won't reverse back into the downtrend, but it may enter that yellow range for a length of time. And here's an example where we do go from yellow to red, back to yellow, back to red, and then the momentum begins again. And most of the time, we are in a trending environment. Here is a nice long trend. Here is a nice long trend. Here is a nice long trend. Even to the downside, this is a relatively nice long trend. So these yellow time frames are typically not, they typically don't last too long. And that's what we're looking to be involved in. We're focused on primarily in being in the market, the majority of holdings or larger holdings when the market is moving higher. So as the S&P 500, particularly watching that SPY, if it starts to show some weakness right here, that's an area to be aware of. And again, it means how big of what are my allocations? What is my position size that I've got? How many holdings do I have? We're getting stopped out of a few trades here. We're getting a little bit lighter positions now. Some of the winners are starting to retrace. We're down to about 20% now holdings, and that's about where we'll probably maintain and watch to see how this counter trend reacts and how some of the stocks are reacting to this counter trend. And if that starts to be an issue where the volatility is too much or the number of holdings is too much, then by all means make those adjustments inside of your portfolio so that you're managing the risk. It's all about managing risk. It's not about trying to squeeze something out of the market that the market's not going to provide for us. Okay, the market's going to do what the market does. We just got to decide how are we going to try and participate in those moves. And in some cases we won't get much of it, or we will get a lot of it, or we'll get a little bit of it. And the only way to get 100% full market exposure is to always be 100% fully invested, and you get the good with the bad when it comes to being 100% fully invested in the market. If it's a really long-term perspective, you've got a long time before you actually might need that capital or to utilize it, then you may be looking at a little bit larger allocation or a little bit different strategy than individual stocks. Maybe it is ETFs, or again, as we've talked about before, utilizing sector where did I go here? Sector ETFs, utilizing some of these sector ETFs, or even just major index ETFs, S&P 500, SPY, owning a percentage of that, and that alone, that's you own 500 stocks by owning just this one share, just this one ETF. You're getting exposure to 500 of the world's leading stocks. That's very compelling. But at the same time, those 500 stocks go up and down, and they can, we can have pretty significant downturns in the market as a whole, as we've seen. I've mentioned this before, and I like to bring it back up because sometimes it takes a little bit of perspective when we're dealing with volatility, and that is and stocks, and that is, do we trust the overall economy, U.S. economy, world economy, and the companies that are producing goods and services inside of those economies? Ultimately, yes, those things are going to move higher. Okay, as evolution and progression, that's ultimately what is happening. We're always going to be moving in the right direction, but we're going to get some pain along the way, some retracements, because we deal with these overshoot. We're shooting too high. We over anticipated that the economy was going to do this or do that, or we get a fun new technology like AI, or we have fun new technology like the internet, 20 years ago, 25 years ago. And so there's always going to be those evolutions of technology and opportunities to invest in those. And the stock market is a fantastic way to do that. But we still deal with risk. We're dealing with how many stocks should I own? Should I own a lot? Should I own a little? Should I own an ETF instead of individual stocks? Those are all things to be able to you have to determine that on your own within your own trading plan and say, ah man, I'm so, I hate getting stopped out of a stock. So what does that mean? Do you stop trading stocks entirely, or do you take a little bit smaller position and have a lot wider stop loss so that your risk is still managed? Let's talk about that for just a minute here as we jump into some possible trade scenarios. Okay, and again, the process of that is, what is the market doing? Where are we at in this market trend? Are we at the upper end of the range? Are we at the lower end of the range? That primarily can be enough to determine how you're going to approach the market. In the shorter term, it can be, man, momentum's up to the upper end of the range. Maybe I want to wait for a little bit more of a retracement to add new positions in. Whatever those scenarios are, we don't always have to be adding something, but when we do, we want to know what the market conditions are doing. Are they up? Are they down? Because that can also add into the overall strategy as well. From here, we want to look for stocks that are moving up in price, and we want to look for something that ideally is a strong moving stock. This is an example of RNA. This is the 2-year time frame. It's gone straight up from $8 to $30. Finally got a sell signal back here. That's the 2-year time frame. If we jump over to the 6-month time frame, we get a little bit different perspective. This is primarily the setup that I like to use for the analysis, just to create the same structure every time. So we're getting the trend, we're getting where we at in that trend, and are we in momentum of that trend or not? Because really, all of this is said and done. Okay, all of that doesn't matter anymore. It does, but it doesn't, because it's moving in this direction. And now what we know is, what is the most important piece of this picture? It's really right here. Okay, where are we at in this current trend? We have our structure so that we know, are we in the upper ranges or are we in the middle ranges of this trend? And so we're getting support. We also know that there's been some volatility and that there's been some buying activity. There was some selling, some more selling. Now starting to find some support right here. And so that creates an opportunity to say, could this stock continue to advance in its trend higher? That's what we're banking on. That's what we're anticipating is it does, and it could, and it should continue to move higher. When it doesn't, then it just flat out doesn't, right? Let's go back. When it goes from green to yellow to red, okay, now we're not, instead of saying, oh, is it going to bottom? Let's buy it. 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 Okay, now we're completely blown out of our account. Okay, that's what we don't want to do. What we want to do is we want to continue to look for opportunities on the way up, but at some point these up trends are going to start failing. Okay, and that's where we get whipsaw, we get stop outs, and we're dealing with that. And that's just the nature of stock trading, is we're never going to get them right exactly all of the time. So what we want to do is we just want to make sure we're maintaining our risk level, and that is controlled by our position size and our stop loss. Okay, so here, if I said I really like this stock, it's moving higher, I have no idea what they do other than it's a medical biotech name. From here, if I wanted to, I could say I'd like to know a little bit more about what they do. What I like to do is click on more and go out to this Google page and then scroll down here and then click on their website. And then sometimes that'll give you a little bit more idea of what are they dealing with. Obviously, we know it's some kind of RNA therapy and biomedical in nature, possibly a drug that has not been approved or that it's being worked on. And those are areas, those are different things that you can take and go a little bit deeper into. What do they do? It may or may not help in the analysis, because obviously what we want to focus on primarily are what are all the big boys doing? Okay, where's all of the institutional heavy money trading? And they're pushing this stock higher. So we know that whatever those guys like, and they're the ones with all the Harvard grads that are doing all of the studying, and they're looking at what's the pipeline look like, and what is the management doing, and what's the debt load, what's the cash balance, and what's the, all of those different fundamental factors ultimately are baked into the price of the stock. Anybody that's made a decision based on that information has either bought or sold the stock. Okay? And so we know that right now the vast majority, or at least the trend, is still moving higher. Investors like this. Okay? And institutions move the market. We are not institutions. We are mom and pops, and we are following along where the demand is happening. And so we're looking for these kind of stocks. The muscle stock group creates a good starting point. There's always a lot of them. But if we catch the upper rank, that means that these stocks are performing strongly against their peers. The rank is 98. This stock is performing 98%, or I should say it this way, it's outperforming 98% of all stocks in its peer group. So it has been moving well, yes. And yes, the move has already taken place. But what we don't know is how much higher and how much longer can a good, strong, uptrending stock last. And that's really the overall strategy of what we're trying to accomplish is we want to be able to look for a stock. And ideally, you catch a stock back here as it's getting, you get a breakout like this, and it's moving higher, and now we're in this zone, okay? And this is as if we're talking about this stock today, and this was back in June. And we're saying, gosh, that thing has already gone so high. How high could it go from here? Well, I don't know, but the tendency is this is low and this is high. We need to buy low and we need to sell high. Yes, that is true. But in the case of a stock, stocks can continue to trend higher and higher and higher and higher. Remember what the overall idea of a stock, of a company is. It's to continually grow. Okay, that's all a company is designed to do, is to grow. When it's not growing, the stock is going to go down. Okay, so when it is going higher, and some companies can make money for 20 years, and that stock may never have a real significant downturn. But when we're in the upper end of this range and we're continuing to move higher, let me just move along here a few days at a time. Okay, there's another gap higher. Okay, now we've got a new high. That fib tool is going to connect to the upper end of the range. And then in this case, the stock just kept going higher. Let's see if we get any. Now, once we start to get a pullback, okay, so now it's going to connect to this high and it's going to pull back. This is the area now of interest of, do we buy in? Do we add a new position? Is this the first position that we add into for the first time? If we were already in a trade and maybe we bought a trade back here, this is where we're saying, hey, something's starting to falter on this price pattern and maybe we need to stop out of this trade or get out of this trade. And this area, this 236 area, creates a good area for stop management. Because once that area is broken and we're already back into yellow, oftentimes that trend is continuing to move lower. Some kind of an earnings report or something, this thing moved higher immediately off of that zone, kept moving higher, higher, higher. Finally get another retracement, pulling back. Really not a super deep retracement, and that's good. That's what we want. We want to think of this zone right here, okay? And that's why I say this is really the most important part of the entire chart. What's happening right here, because this is where we want to be out, and typically this is the location that we want to try and get into, and then take advantage of a stock that keeps moving like this, okay? And this is where we're at as of today. So that chart, that view that we just looked at, this was that entry where we said, good grief, that thing has gone straight up from here to here. And that was at 17 and now it's at 44. Okay. Oftentimes we do, it's for whatever reason, it's hard to hold on to these winners. And, and about 40% of the time, you're going to get some winners. 60% of the time, you're going to get stopped out or have break even or a small loss or a small gain. Okay, the other 30 or 40% will get a big winner or two. And with this strategy, that's ultimately what we're banking on, is to get some of the big winners and allowing them to really run. Now, obviously, we're going to take some of the gains along the way. We have some strategies to sell into the strength. Depending on the market conditions, you can sell into that strength at 20% gain, selling 25% of the holdings, at a 50% gain, selling another 25%. So now you're up 50% and you still have half of the position, but you've sold half of the position into the strength. Okay, that's a little bit more conservative strategy to lock in some of the gains along the way instead of just using a full trailing stop the entire time or selling at a target and then getting rid of the entire move. Because oftentimes this is what happens the next day, right? You sell something and the next day it's like, good grief, that thing just rocketed higher, and now I don't have any shares in that at all. So being able to, number one, start out with a position size that's manageable. Let's go back to this stock 3-month time frame. Okay. And we've talked about this before, and I'll end on this note, but we talk about, here's our bar, here's our bullish bar. We didn't get great volume, but it was increasing volume over the prior day. And that could be a deterrent from adding in at these levels. Okay. But I want to know, what's my position size? Number one, how much portfolio risk am I going to be taking? So if this is a $45 share or stock, 50 shares on this is going to put me right at 2%. Okay, I'm focused on this number down here. 2% is going to allow me to have, worst case scenario, I lose $2,000. That's if this company drops to zero. Okay, the probability of that is not very high. There is a probability of it dropping by half, though. So if it were to drop by 30 or 40%, because it's a biotech name and it's a higher risk, I could experience a lot of volatility. That thing could drop, and it could drop significantly. I may not want to deal with that, but this typically allows us to manage our risk for those unknown scenarios. A gap, massive gap to the downside. Something comes up with their drug or with the FDA or with their books or with their management, or whatever the scenario is. The unknowns are always the ones that get us, and we want to make sure that our risk is managed. Now, the hard thing of this is when we have a small position, this thing could go up 100%, and that means our portfolio is only going to go up by 2%. So we have 100% gain on the stock, and our portfolio is up 2%. Well, so be it, right? There's no way to get the best of both worlds. I could take higher risk. I could add more shares. Okay, now 4%. Now if the stock doubles, I make 4% instead of 2%, but my risk is also increased. So there's always a direct correlation between your risk and the position size and the reward. And there's no other way to get around that other than just being okay with the size of the risk. And that's okay too. You could say, I'm willing to go 4. I'm willing to go 10% or 8% and have a little bit bigger position. But maybe I have a super tight stop loss so that if it only moves down a tiny bit, I get stopped out of a bigger position. Those are the two factors that I can manage, my stop loss and my position size. So let's go back to, what did I say? 150 shares, 50 shares, and a stop price. Let's just say, right here, typically if you go the most recent low point, or you could even go down below the low point of this past swing low point here, or I could even go back all the way down to the 382. Let's say $38 and see what that looks like. If I have a stop at $38, that puts me at 0.37. That's a pretty wide stop. That's 18%. That bumps this portfolio risk up to 0.37. That you may be okay with that. If you're okay with that, then fine. It's a wider stop. It gives you more volatility. Okay, but typically, if you're going to have a deeper stop and the stock comes all the way back down and it breaks this, maybe it'll find some support and then it moves up. But in most cases, we want to set a stop loss in an area that, if it's going to stop us out, it's probably got a broken trend structure and is on its way back down anyway. And so we just want to exit out of the trade, let it do it, let the trend unfold how it's going to unfold, and we will be on the sideline while that happens. So we get stopped out of quite a few trades because we typically have those to set relatively tight. I don't want to have a deep stock moving lower and then not be stopped out and then have a bigger loss and then have to wait and have that capital tied up to wait and see if it's going to recover. Maybe it doesn't. Okay, so we want to make sure that we understand what our risk is in advance and we're managing that risk accordingly. Okay, so in this case, 38 might be a little bit too wide. Let's jump up and go to the low. This low right here is 41. So let's go to 41. That puts us at 0.24, 12%. That's a little bit more realistic. Okay, it's a little more reasonable. That would be the range, and that can depend on market conditions. Market conditions were a little bit toppy. I may not want to have a big position. I may want to have a little bit tighter stop loss. I'd be okay with that. Okay, and then now you go into the trade, you pull the trigger and you say, I know that if I'm wrong or if the stock moves lower to this point, I'm going to be stopped out of that, and this is the amount that I'm going to lose. Okay, in exchange for the possibility that I make a whole lot more than that. Okay, that's the exchange, as I'm anticipating that this is just a pause in this trend. Now we're going to continue to move higher from here, but I just don't know that. I don't know the future. It certainly could go higher. It certainly could go lower. If it go lower, I want to make sure that I've managed my risk accordingly. I'm going to end on that note. I appreciate everyone's time and effort, and We'll see you next time. Thanks a lot. Bye now.